The Nobel Prize-winning economist Milton Friedman criticized President Richard Nixon's price control policy, considering it to be very harmful to the economy in the long term. However, Nixon responded that he didn't care what Friedman said because Friedman wasn't running for re-election like he was. Politicians usually govern with short-term goals, focusing on the next 4 years because anything beyond that is secondary to them. Politics is about tactics, not strategy. That's why the decisions made by the United States since the 1970s were not aimed at the distant future but rather at immediate concerns and their own interests. Despite the fact that some of these policies initially seemed social democratic, such as the minimum wage, price intervention, and massive public investment, what followed was a plan that would not remain confined to the US. Instead, their model expanded globally, forcing the world to serve US interests. Europe was a top student of this approach. Now, it's probably clearer than ever that the global plan designed by the US to rebuild Europe and Japan after World War II in the image of its own economic structure marked the beginning of a silent dependency. From the end of World War II until around 1971, the Western world, led by the US, experienced a period of remarkable economic stability characterized by low unemployment, low inflation, high growth, and a significant reduction in inequality. During that time, the New Deal policies, initiated by President Franklin D. Roosevelt and continued by his successors, revitalized the U.S. economy and exported its successful model to other nations, creating a robust global economic system that aligned with U.S. interests. Stay tuned, because today we'll explore how this system was built on the power of the U.S. dollar, and how it has ultimately led to an irreversible situation, sustained by debt that no one seems to want to acknowledge, especially in Europe. So stay with us, because what I'm about to share is important. Oh, and by the way, Nixon won re-election. Hello to all the community of Finance for All, welcome to another video. The Bretton Woods system, established in 1944, laid the foundation for the post-war global economic order. At the center of that system was the US dollar, backed by gold, and linked to other currencies through fixed exchange rates. This structure allowed the US to consolidate its global economic hegemony by making its currency the world's primary reserve. However, the success of the system depended on one fundamental condition: the US needed to maintain a trade surplus, exporting more goods and services than it imported. This wasn't always possible. That surplus ensured that dollars in circulation would return to the US. Not only did it have the stability of a fixed exchange rate for the dollar, but the US economy was driven by a booming manufacturing sector. It massively exported high-quality industrial products, including airplanes, appliances, and cars, ensuring that the dollars sent abroad through aid and loans returned in the form of payments for exports. This created a virtuous cycle where the international demand for dollars remained consistently high, consolidating the dollar's status as the preferred currency in international markets. However, this system began to show cracks in the late 1960s due to three main factors that eroded the U.S. trade surplus, essentially turning it into a chronic deficit economy, a situation that persists today. This increasing pressure helps explain why the U.S. gets involved in some conflicts and avoids others, although that's a different story for another time. The first factor was the Vietnam War. This conflict forced the U.S. government to spend billions of dollars on supplies and services for its army in Southeast Asia. This military expenditure, largely financed through debt, with no direct economic return, diverted resources that could have otherwise supported the trade surplus. The second factor was that the economies of Japan and Germany, bolstered by previous U.S. aid to rebuild their industries after World War II, began to outperform the U.S. in terms of efficiency and production quality. A prime example is the automotive industry. By the 1970s, Japanese and German cars began to dominate the global market, displacing U.S. automakers and further contributing to the growing trade deficit. The third factor was President Lyndon B. Johnson's ambitious Great Society program. In an effort to mitigate the negative impact of military conscription on the American working class, Johnson implemented this costly program. While it did significantly reduce poverty at one point, it also increased imports of goods from Japan and Europe. This rise in imports further eroded the U.S. trade surplus. Faced with mounting economic pressure and the loss of the trade surplus, the U.S. was forced to abandon the Bretton Woods system. Now let me explain what that meant. On August 15, 1971, President Richard Nixon announced the suspension of the dollar's convertibility into gold, effectively ending the system of fixed exchange rates. This Nixon shock, as it became known, was a series of measures that opened the door to a new global economic order, marked by significant financial volatility. With the collapse of Bretton Woods, Western banks and financial institutions, now freed from the restrictions imposed by the previous New Deal policies, began experimenting with new financial instruments. Among these were derivatives, which had been available during the Bretton Woods system but were under strict control. Once that control was lifted, derivatives became a key driver of uncontrolled financial expansion, which eventually led to several disasters that, to a large extent, we still haven't fully recovered from. The legacy of that era persists today in the inability of central banks to do anything other than rely on debt, either buying it or launching quantitative easing programs whenever cracks appear in the system. They learned that jumping into the void was more profitable than transforming the system. In 2002, 30 years after all of that, according to former Greek finance minister Yanis Varoufakis, global income reached around $50 trillion. However, that same year, speculative capital in the global financial market, composed of financial assets, stocks, currencies, and derivatives, had reached $70 trillion. That might seem reasonable, but the real issue lies in its evolution. In 2002, the ratio was $50 trillion in income versus $70 trillion in speculative capital. By 2007, just before the major crash, it was $75 trillion in income against $750 trillion in financial bets. Obviously, the global banking system had become overblown, and it soon exploded into 1,000 pieces, just like the financial products it had broken into for all its clients. Financial markets had never before been so disconnected from the real economy. Surprisingly, this caused fewer problems for the United States than one might expect at first glance. The root of the explosion lay in the creation of complex financial instruments called derivatives, which allowed banks to make enormous speculative bets. These derivatives, not backed by real assets and used primarily for excessive leverage, created a financial bubble of unprecedented proportions, which burst overnight. One of the most striking features of this period was the ability of banks to create money out of thin air, without any underlying value. Contrary to popular belief, banks don't simply take depositors' savings and lend them to others. When a bank grants a loan, it doesn't physically need to have the money from its clients' reserves. It creates a deposit in the borrower's account, thus increasing the money supply without requiring real assets as backing. This process, through which commercial banks generate new money by granting loans, has been fundamental to the exponential growth of debt in the global economy. The expansion of bank credit has led to a significant increase in the total volume of money and debt in circulation. Remember, debt is ultimately your debt, not that of governments or their leaders. This helps explain why, if a bank collapses, it's your money that's at risk, beyond the coverage provided by guarantee funds, assuming, of course, that those funds are enough for everyone, which remains to be seen. This mechanism of creating money without real backing worked well as long as borrowers used their loans productively and were able to repay them with interest. The system operated smoothly under those conditions. However, as banks began granting riskier loans and packaging those debts into increasingly complex financial products, the system became more unstable and opaque. Bankers decided to split these products into smaller pieces, mixing them with others and dividing them again. The idea was that this would minimize the risk of any single loan defaulting. But they didn't stop there. Guess what? They then created insurance on these packages and continued to break them down into atomic fragments. These small fragments of the original loans were then repackaged into new products, which were now indecipherable. At this point, bankers thought that since the composition was so heterogeneous, they could accept clients with low creditworthiness, spreading the risk across millions of financial bubbles. The result? Slowly, more toxic assets began circulating than healthy ones. The US had engineered a model that allowed it to live in perpetual deficit, thanks to the financial system's ability to create unlimited money and distribute it through derivatives. Once their market was saturated, they decided to export their model to every corner of the world, especially Europe and Japan. Finally, one day, someone noticed, ironically, in France, that this was happening and refused to engage with these toxic products. What followed, we all know, the economy collapsed like sinister dominoes. But it didn't unfold as we initially thought. Many believed the US was the biggest loser, with failed banks, unemployment, and economic depression. But the real hit was in Europe, where the shockwave hit hard and came in waves. In Spain, for example, the final blow came in 2012. And now, here's the kicker: how could this have happened? How is it possible that these highly educated bankers, with all their expertise, didn't see the disaster they were creating? They probably did notice, but since Nixon's time, they've followed the same playbook. The bankers knew they could transfer the risk to other market actors, so if things went wrong, governments and central banks would bail out the collapsing institutions. The problem was never a lack of regulation. The real issue was the guarantee that the public, you and I, would rescue their greed. The US national debt is so vast that it requires a massive, unbroken loop to keep going. It needs a system like the one we have now: create money, export debt, and remain the issuer of the world's most widely used currency. European debt doesn't have those components or the same needs. The problem in Europe is that the aim seems to be replicating the model of the world's leading power, something we simply cannot manage. Europe can barely meet its obligations without creating money out of thin air, which would destroy us all with inflation. The real challenge is becoming relevant again. The world is now divided into two poles, the United States and China. Both innovate, both produce, and both encompass the future financial model, the former by creating dependencies for others, and the latter by structuring immense power in many parts of the globe. We are witnessing the greatest industrial, economic, and social revolution since ancient times. Though many downplay it, artificial intelligence is part of this transformation. However, it's not just another technological shift, it's a metamorphosis like no other. We're not creating technologies to assist us, we're creating technologies to replace us. In a time like this, if the only contribution Europe can make is regulation, we're in trouble. The US innovates, China imitates, and Europe stands still. Right now, Europe is too preoccupied with immigration flows, maintaining a cultural model that is crumbling, or relentlessly suppressing dissent by labeling it disinformation. But time is running out, and it won't wait. If Europe doesn't analyze and internalize everything I've described today, it will repeat the same mistakes, deepen its dependence, and eventually vanish into the fog of history. One day, someone might talk about Europe the way we talk about Atlantis now.